This video is the fifth in our series on core options trading strategies. And the title of this video, which should last about 35 minutes, is Vertical Put Option Bull Credit Spreads. And you say, well, that's really a mouthful. Well, all of those terms describe exactly what it is we're going to invest with here or play with here. We'll shorten the term a little bit within the presentation. So let's get going so that we can get through this in a reasonable period of time. So here are some key questions we're going to be asking at the beginning that we're going to answer in this video. What is a credit spread? And what is the significance of the word credit? Why is that in the term? What kind of bet is a credit spread bet? Why would you make such a bet? 3, what kind of payoff does such a bet have? And these are known to be popular, which is why I'm choosing them. Why are these so popular? This is partly because of the payoff we'll see. What kinds of strategies likely won't work with credit spreads? We're going to defer most of that discussion to a separate video where we go through strategy. That'll be at a very complex and deep level. We're not going to get into it here because that would have turned this into a 1-hour video. And what kind of strategies will likely work with credit spreads? What are some candidates? Some of that we'll discuss here superficially. Most of that we'll discuss in a dedicated video about strategy regarding spreads in general. And finally, is there an algo or a computer-assisted trading algo, which I call now CATA, that we can use? And yes, there is. The algo was actually used to prepare much of this lecture, and I'm going to release that algo to you, so it is very practical. Let's take a look at some definitions, though, before we look at the results of the algo. Now, a spread is typically a two-legged bet consisting of the primary bet, which usually involves writing a naked call or put, so you're writing an option, and a hedge, which involves buying a call or put of the same underlying at a different strike price, usually the case, or a different expiry, sometimes the case. And we're talking about the former, at a different strike price today. Writing a naked call or put exposes the writer to a potentially huge liability, even if improbable, for a relatively small gain. And we'll show an example of this very soon. Critics of naked option exposure refer to this as picking up dimes in front of a steamroller. In other words, it's easy to make small profits, but if you have a little bit of bad luck, or as we'll see in the lecture, a little bit of tail risk, you can be run over by a steamroller. A spread is a lower risk alternative to writing simply a naked call or a put. Placing a hedge on the original bet by making a smaller opposite bet reduces the maximum gain possible from the original bet, but also eliminates the risk of a huge loss. Therefore, spreads include a primary option bet that is written and another that is a hedge. And we'll see multiple examples of this. If you trade two options, whether buying or selling, with the same expiration date, this is called a vertical spread, and that's what we're investigating here. If the two options have different expiries, that is called a calendar spread, and we'll talk about those more briefly in a later video because most people do vertical spreads. Finally, if you write one option and buy another in a vertical spread, if the option that you write is more expensive than the option you buy, this is called a credit spread because your cash account will be credited. That is, cash will be added to your account at the beginning of the transaction because you're writing net a put option in this case. If, on the other hand, the option that you buy is more expensive than the option you write, and that's not what we're describing today, but it's possible, this is called a debit spread because your account is initially debited with the difference. So we're talking about a credit spread where in the opening transaction you actually have cash added to your account because you sold something. And this explains some of the popularity of the credit spread. If you profit if the underlying stock goes up, then you have a bull spread. Otherwise, you have a bear spread, so it's playing a bear spread. The video emphasizes, which probably is the most popular form of an option spread, which is a vertical credit bull spread, which can also be called a put option bull credit spread because it uses a put, or just put credit spread because vertical is assumed, and if it is a put credit spread, it is automatically a bull spread. You are hoping the market goes up, stays the same, or only slightly declines while you are in position. You are making the bet because you expect that to be far more likely than a market decline. And remember, even though we're using puts, we are writing them, we're not buying them. The other classes of credit spreads will be discussed in another video, since once you understand one, you'll understand them all. In this, Now, remember the last lecture about volatility skew? I snuck that in there into this discussion. That was part 4 of this series, because you can't talk about spreads being rationally justified or logically justified unless you understand the reality of volatility skew. This was from that slide set, and we remind ourselves that net hedgers on the underlying, that is mutual funds and those that hold the underlying stock portfolios, are on the left side of the stock price because they are hedging long stock positions with puts. So we explained the rise in the volatility skew on the left side of the mapping, which is in this case the entire mapping actually, but on the left side of the mapping certainly from the current stock price, with the fact that that's an insurance pledge. So even if the true IV is the value represented at the money, which here IV is at the money, out of the money puts are trading above their so-called fair or efficient value. The spread above fair value is the insurance premium that is awarded to speculators. It may in fact include a premium for tail risk as implied by jump diffusion models. So we said that in that lecture. And we remind ourselves this is apparently one reason why professional traders like to write cash secured out of the money puts, because they are logically justified. Basically, if you write a cash secured out of the money put, then you're trying to cash in on this insurance premium that is made implicit by the volatility skew. So there is a justification for doing this, mostly on the put side. Now here's the strategy before we visualize it. And again, for these videos, I am posting a PDF shortened version of it so that you can go back and look at this if you're a little confused about what was said. And when you see the graphics, you'll probably understand this all quite a bit better. That isn't posted when I do this live presentation. It's posted later in the day when the archive version of the live presentation appears. Continuing on with the strategy, the options trader doing a bull credit spread essentially writes a put, typically near the money but out of the money, to a counterparty who is buying the put. Now I have an asterisk here, and it says this is not a hard and fast rule. There are reasons to write in the money puts, but we're not going to consider that, and I'll explain why later in the video. Because she's writing a put, her account is credited for the value of the put less fees. And throughout this presentation, we ignore fees. Usually, given the scale of the transactions, if you're using a broker like the one I use, Interactive Brokers, the fees are inconsequential. Often for a large trade involving, say, $5,000, the fees will be, say, $3. So to simplify the lectures, we just assume fees are zero, or figure out, you can guess that there's going to be a slight difference in the return because of the fees. Now, because she's writing a put, her account is credited, and that implies that the cash value of the account arises at the transaction. So when you write a put, the cash value of your account is increased by the size of the sale. But as the double asterisk points out, although this cash is credited to the account, it's there and you can see it. It is committed, and it cannot be used until the trade is over. And in fact, sometimes until a couple of days after the trade is over, because Federal Reserve rules allow as many as 2 or 3 days for settlement. So the cash is there, but it is restricted. So far, the put writer has a huge potential liability because she has written a naked put, and we'll explore that graphically here in a minute. Therefore, she should hedge, her written put. To do that, she caps her liability by also buying a less expensive put that is further out of the money. Now, this one she buys, the other one she wrote. On net, the hedge will reduce her credit and her maximum profit, but will prevent a catastrophic loss in case the underlying stock has a 4 sigma plunge. That really is the problem with writing naked options. There's a lot of tail risk, especially in markets like this. And so long as you don't have that Poisson distribution scale event when you're in position, then usually you can make pretty good money off of these. Not as a high rate of return, but it's just consistently profitable on a small scale until the big sigma event happens, and that can wipe out all the profits you've made over the last year if you're not careful, or even more. In a later lecture, I'll give you by a tail event. Often the person writing the bull credit spread will choose deltas that enhance the policy, such as write a put with an approximate 0.45 delta and buy a hedge put with an approximate 0.25 delta. So many people use deltas or a delta range to decide how to set up the credit spread. And again, we'll look at examples. So this, in a nutshell, is a verbal description of what the trader wants to do, but this will be easier to understand if we choose a current example, which we're going to do here, and talk more about what this looks like graphically. Let's visualize this. So to do this, we are going to choose or have chosen SPY, because SPY is so liquid, it's an easy example to use, and I do this sometimes here. So this options chain came from Thursday, May the 21st, a little after noon, and it's for the May 29 expiry, which is actually tomorrow from the time of this recording, but 8 days away when I captured this. And because we are looking at puts only, let's cut it in half and look at only the put side of this. So you can see in here we've got a whole bunch of strikes. Most of these are out of the money, and we're going to decide that we want to write one. Now let's first take a look at writing a naked put, why that is probably undesirable. So for that, let's say we want to write a 290 put. And you can see that we can get a price around 230 if we get the peg between bid and ask, if you look at the quote there. And that $2.30 times 100 times however many contracts you wrote for is credited to your account at the moment you make the transaction trade. Okay, so what does it look like? Well, remember we looked at this using this expiry related graphics about 2 or 3 videos ago. And we're going to use those to show here why you would use a credit spread. And again, there is one limitation of this. We're talking about the value only at expiry, and in American options you can get out before the expiry. But nonetheless, this is very revealing. So first of all, we're not going to look at this option from the standpoint of the option writer. We're going to look at it from the standpoint of the counterparty, because you've seen that before. This was an example, or very similar to an example, of where we talked about why one would buy a put. Now, to make sure you understand what we're looking at, we are looking at the stock price as the green line. The strike price is the red line, and so the stock price is $295.38. The strike price was out of the money, $290, and its value is $230. And then, of course, our break even is 287.7, because the price has, by expiry, has to go to that value for us to break even, given that we paid $2.30 for the option. So again, the region where we would lose is, in the maximum loss is above the strike price. Between the strike price and the break even point, then the loss narrows and past the break-even point. In other words, for prices in the underlying lower than 287.5, then that's the gain region, and that's where we start making money. So you've seen this before. It's important to note here that our loss region is 230, because that's what we paid somebody else for this option. And that's kind of the point. So let's switch this over to the perspective of the option writer, because that's who this lecture is talking about. Now, if we don't change the axes at all, or don't change anything about the graph, we realize all we have to do is relabel the gain region as the loss region for the previous slide, and the loss region as the gain region for this. So if you're the option writer, then you have made $2.30, and that is credited to your account because you sold this same option at the strike price of $2.90 for $2.30. We got that from the quote page from Interactive Brokers. Now there's a problem here though, and these values are not consistent with the signs of the axes. You take a look at the little $2.30 in the gain region, you go over to the y-axis, that's a negative value. So to understand the credit spread a little bit better, we need to invert the mapping, and we end up with it looking like this. It's the same thing, but it shows now a perspective that's consistent with the y-axis. So for the option writer who wrote to the counterparty, the gain region is shown here as positive 2.3, consistent with the y-axis. And of course, the gain or loss is the exact inverse of what it happens to be for the person who bought your option. Now we're ignoring once again the fees in this, although the fees for trades of this kind are not very high. Now to compare this to the previous, this is what we did. We inverted this slide. So if you look at the little inset slide over here on the right, that was basically from the buyer's perspective, but we're looking at the seller's gain and loss for that. We said, well, that's not matched with the graphics. So we converted that slide to this larger slide on the left, and we'll stick with this kind of slide throughout the rest of the lecture. Now, we can see where the division is between being in the money and being out of the money. So again, we remind ourselves that we have written an out of the money put. And so we're going to have the maximum gain here at $2.30 anywhere that the option is above that strike price. Okay, so let's shift the graph though. In doing so, we want to explain why maybe this naked put writing option, cash secured naked put writing option, is maybe not something we want to do, because the gain is certainly capped. The gain is capped, as we saw, at $2.30. You can see the gain region line goes flat at the strike price, but the loss region is not capped. And there is, therefore, significant tail risk when you write options. Now remember, tail risk is represented by the fat tails, or by the kurtosis, technically, in statistics that you see in the mappings of the daily continuous growth rates of these stocks or these ETFs, in the case of this being an ETF. We know that tail risk is quite serious, and it is fairly random, and even though when we assume that the stock is going to behave within its little Gaussian shell, we say, well, this loss is a big region and it goes down low, but we're talking about 3 or 4 sigma out there. So within the context of the Gaussian distribution, that's not very likely, so we don't have to worry about it. But we know that there's the tail loss problem, or tail gain problem, but capped because you've written a column. So tail event risk is hard to represent in models, and that actually poses 2 problems. It means that you can suffer from false confidence as you continue to pursue this strategy of writing naked puts, and you could win in 20 or 30 of them in a row, and then the big tail event comes and works against you, and that can produce a loss so large, and it can do it in the overnight markets where you can't trade out of this option while it's happening, that these large profits are wiped out. So here we go clear down to why we're not going to do it. Now I should as a footnote that if you write naked options, they have to be cash secured, which is to say that the full value of the loss you might experience has to be in your cash account locked down, or you have to have a margin account where you have the means to use margin to borrow against your loss if this happens. Neither of those is very desirable, and that's why we're going to choose a hedge. So let's restart this, because we want to choose a put that's a little bit closer to the money for doing this. So let's go to Thursday, May 21st, May 29, expiry 8 days. That's the same expiry. The price of the stock is still $2.95, as you can see. And let's do this. Let's write a $2.92 because that's closer to the money. We'll get more money for it. And we're going to be able to write that for $2.85 or $2.86. And the $2.88 is going to be basically $1 lower. And we're going to buy that as a hedge. Let's see what that looks like. So when we map that out, we get this. So the purpose of the hedge. So the green line represents the stock. The red line represents the short strike. And the orange line represents the hedge strike. Because the short strike is closer to the money, it's more valuable. The hedge strike is further away, it's less valuable. The model we're using to generate these mappings also puts out a lot of additional information about the hedge and the original, about the strategy actually. So let's take a look at what it says here about this kind of trade. Now anyway, let's look at this. Okay, we chose a short strike of 292, remembering that the stock price is 295.38. The short strike price that we earned was 285, and so that's a lot more than what we earned on the previous for writing the put. The delta that we've chosen here, which is calculated in the program separately from what we're discussing here, was 0.36. And again, for deltas on puts, I use their absolute values. Because I do so many strangles that I just like to compare absolute values, so that's my personal practice. Normally the delta mathematically is a negative value for a put, absolute values for me. The hedge represented here is at 288. The strike price is $1.85, so that's a cost because we're buying it, and the hedge delta is only 0.26. Now there's more information that the program provides. Our max gain, which is the net cash from the spread, is equal to $1, and our max loss is larger at $3. Now let's explore that to make sure that's understood. The maximum gain is simply equal to the price of the primary bet when sold, which in this case is $2.85, minus the cost of the hedge when bought, which is $1.85, so the maximum gain is $1. Less fees, again, which we're not including in this. And the max loss is larger. It's equal to the strike price of the short, which is 292, minus the strike price of the hedge, which is 288, and so that net spread is 4, minus the original credit, which was 1, in other words, minus the amount we made by selling the put. And so the maximum loss we can realize on this, if the stock price goes below the hedge strike price, or 288, is $3. So you say, well, that's not very good. The gain is only $1 and the loss is $3, but you have to visualize, looking at the green line, that it has a Gaussian distribution around it, and the strike price for the hedge is way out there on the tail of it. So before I say that, for the put credit spread structured this way, the max loss is always going to be greater than the max gain. No matter how you do a put credit spread where both are out of the money, then you're going to get a max loss always greater than the max gain. And now I can say, but the probability of the max gain is very high, in this case 0.61, and the probability of the max loss is considerably lower, 0.2683 in this example. So we're using some kind of model, as you can tell, to calculate what the probabilities are of hitting the strike prices, and we'll cover that later. The probability of the max gain at expiry will be considerably higher than the probability of the max loss, as we just said. Well, the model that we're using has a built-in version. The student version has Black-Scholes-Merton to calculate the deltas, and so here these are these calculations done, in the separate model that you already have. I use it. So that's where those calculations came from. They're added to the mapping model to calculate both the deltas and to calculate the even the implied volatility, although we don't use that much here. The implied volatility does suggest to us that that we have the skew in the implied volatility, the volatility skew, because as you can see at the very bottom here, the 288 has an implied volatility on this day of 0.015, whereas the closer to the money has 0.013. So that's consistent with the volatility skew that we've seen, something like that. So as we said here, we remind ourselves the person writing the bull credit spread will choose deltas that enhance the policy, such as write a put with an approximate 0.45 delta, then buy a hedge with an approximate 0.25 delta, because that gives them the mix that they like on the insurance and on the actual credit that they get. Before we explain why they would do this or do that or use a higher or lower delta, we have to introduce ourselves to assignment risk. Now, in general, the strategy just discussed certainly reduces the risk of losing a very large amount of money, especially compared to the relative size of your maximum possible gain in the case of a naked put. So sure, we've capped the loss, but it still includes another component of risk that must be taken into account. The risk that your option will go into the money and a counterparty will exercise the put, and the necessity of buying the stock at the strike price is randomly assigned to you. Now, what happens, of course, suppose we have our put at 292, suppose the price of SPY near expiry or at expiry goes down to 290, well, your put is in the money. And so there's a good chance that that option is going to be exercised by the counterparty. And that implies that the broker is going to require a margin account and or plenty of cash, enough to cover the cost of assignment, in this case a little less than $30,000 before you can do this. SPY. So the first thing you have to do is buy the SPY from the market at the current price and then satisfy the put. And you have to have the funds in the account to actually make the purchase of SPY itself. That's $30,000. Now, if you have a margin account, you don't have to have $30,000 in it, and not all brokers require that you have 100% coverage, but some do, and currently Interactive Brokers does, so far as I can tell. And so, therefore, you have to have a lot of cash set aside, even when you have this hedged. And this lowers, as we say here, the effective return on investment on this kind of investment, because you have to have cash that is uncommitted, sitting idle on the side. And so the cash cost of going into this transaction is not the credit you get. The cash cost is the amount of margin you have to have effectively ready to satisfy assignment, and that's a much, much larger value. And that, again, lowers the ROI. And the price may also plunge through the hedge strike, which in our case is 288 as well, and that's actually advantageous to some extent. That's when, of course, you get your maximum loss. So you can exercise your put to sell the stock you just bought at a maximum loss to at least restore your cash position. So in other words, you can pass it through. But the broker's not going to count on this happening, and there still has to be a cash transfer, even if one transaction cancels the other on net. And again, this policy does vary by broker. So in summary, the delta trade-off between max gain, max loss, and the probabilities of gain and loss can be described here in summary form. This is where you're choosing the set of deltas you want to use in your transaction. So the short put, the primary bet, the closer you get to the money, or in other words, the higher the delta, the greater the value of the put, therefore, the higher your maximum gain. But the probability of the maximum gain is lower, so you have a higher maximum gain but a lower probability, and more important, the higher your probability of assignment, obviously, the closer you are to the money when you write your put. For the hedge, the further you get from the money, the lower the delta, then the less the value of that put, therefore the higher your maximum gain, because it cuts into your maximum gain because you have to buy it, but your hedge is at a lower price, so the higher your maximum loss, and the higher your probability of assignment of only the primary bet. So 288. So let's look at some of the choices we have by respreading the delta for a higher delta and for the short, and a lower delta for the hedge, okay? So let's choose a higher delta for the short, and that's going to involve buying at a higher price. And let's choose a lower delta for the hedge. That'll increase our maximum gain. And as you can see, it does. The maximum gain is $1.67 compared to $1 on the previous example, and this is the same chain. So the short strike is now 293. So that used to be 290 and 290 for the naked, and 292, now it's 293. The strike price is 317, and the short delta is now 0.40, so we're getting closer to 0.5. The hedge, however, is 286. That's $2 less than the last one. The hedge strike price is considerably lower at $1.50, and the hedge delta is only at 0.21. So it's out there at to the left of 1 sigma. So we get for that result a higher max gain, but as you can see here, but we also get a higher max loss. Now the max loss is down to 533, and we also get the probability of a max gain at 0.58 and the probability of a max loss at 0.22. So the probability of our max gain is lower than it was in the previous example, but the gain itself is higher. So that's the kind of trade-off you have to take into account. Now let's respread for a higher delta for both, that is closer to the money. So both of these are now closer to the money. And we have reduced our gain because of the fact that our hedge has got more expensive. So now we're doing a 294 for the short and a 290 for the hedge. And so we can take a look at this, and we can see that the price is 353 for the short, but the price for the hedge is considerably higher at 230. So the net is only $1.23. So it's higher than the $1 we started with, but it's lower than the previous example. And we have the max gain, as we just said, 123, but the max loss is a little more tolerable at 277. So this is probably a better combination, or would be seen as that in the eyes of most people. And though we have a probability, once again, of a max gain of a little bit less, and we have the probability of the max loss at considerably more, almost 1/3. So those are the kinds of trade-offs you have to make when you are creating these credit spreads. Now, it's not just SPY. Let's take a quick look at a credit spread for AMD. On Tuesday, May 26, a different day, 12:30 Pacific time, looking only at the puts. And so using that, we took a look at this, and we can see, I won't use red arrows, you can just read down here. We have a short strike at 52, we have the hedge strike at 48, so the max gain is $1.14. This is a $50 stock. Assignment risk wouldn't be quite so bad for this, because this stock is only a $52 stock, so we'd have to have $5,200 for 100 shares. The probability of the max gain is 0.56. The probability of the max loss is 0.244. But we really haven't discussed much the strategy for doing anything like this for either AMD or for SPY. Now, sometimes when you go to the YouTube especially, where they talk about options trading strategies, but also on Reddit, you often hear the claim, you should always write these things, or at least look for one that has a high implied volatility and just write spreads, or even do cash secured puts by themselves for high IV stocks. Now, that's not very good advice, because if it has high IV, there's a reason for it. It's because the asset is considerably more volatile. And so that's why the IV is representing a higher premium for a more volatile asset. And oftentimes that volatility implies a much greater level of tail risk, as we have seen by multiple examples in the class. So it's not necessarily the case that you want to do this for a high IV stock only, or that's the criteria for choosing this. We're not going to say what the criteria is, but we have already suggested that paying attention to volatility skew may give us some basis for doing this, so long as we have a model that can make the proper comparison. That's the next video. And then at the same time, we'll have other examples about why you might want to write puts that are secured with a hedge, because there are numerous reasons to do it. They won't be discussed here because that would double the length of the video. So we'll just say this about it for right now. Is this strategy going to be profitable at all times? Can you just go out and write put options against ETFs and things like that and expect to collect money because you're getting credited at the beginning, and the probability of keeping all of that money is greater than 50-50? Is this strategy going to be profitable at all times? And the answer is no, it's not. This has to be a strategy that is guided well by sound thinking and, in my opinion, by models. Now, I base that on research that includes research like this. This was published about a year ago, and I actually want you, if you're really serious about this, to go to that link there that's at the top, SPY Put Strategies, and read this article, because this was based upon a backtesting study, that started a long time ago and continued up to 2019. This research suggested that put writing and put credit spreads, when generally applied, will not outperform SPX, which really shouldn't surprise us. This is a graph from this research. And well, the graph really sums it up. Not a single back-tested strategy, including in-the-money debit spreads, beat the SPY over the testing period. And he has a mapping of everything he tested between 2007 and 2019. So this is yet another case of why bother if just invest in an index fund. But as I say, this is not discouraging, because why would it be? None of our theories allow for super profits persistently from the same kind of repeated bet. That's why we started with a qualified discussion of the efficient market. There's no market out there, no matter what you look at, that is going to provide super profits to the same consistently applied bet, because we know that arbitrage will go to that profit and squeeze the profit out eventually. In other words, if it's really profitable to just write puts, more people will be writing puts, which will take the premiums on those puts down and flatten out the volatility skew in such time as the profits are the same as everything else. But it is the case that a lot of these mappings actually approach the SPY return, which is impressive and may be due to the volatility skew. So it's not as though this was really, really a bad strategy. Some of those are close to SPY. But as always for us, we want to be in this market when our models tell us that this market is temporarily generating abnormal or anomalous returns. That is to say, we're going to try to seek those candidates for writing puts that are secured by hedges in a future discussion. Are we able to do that yet? To the slide. Yeah, we have a model, and this is the top of the model. This is actually the model that was used to generate all the information here, all the slide mappings, and I'm going to give this model to you. This model hasn't quite been completed for your use, because for you we're using Black-Scholes-Merton because you understand that better, but fairly soon, probably not in the next slide set, but in the one after that, then we'll talk more about the kinds of strategies where we can figure out that it's advantageous to actually write these puts that have hedges under certain circumstances, and those will be ephemeral circumstances that we expect to disappear after a period of time. So we're going to stop with this by saying here are the key takeaways. A vertical put option bull credit spread, or the put credit spread as we're calling it, is used for the same reason that one might write a naked out-of-the-money put, but reduces the risk with a hedge because the risk is technically unlimited with a naked option. You write an out-of-the-money put and you buy an out-of-the-money put that is cheaper. The right is the primary bet. It's closer to the money at a higher delta and therefore more valuable than the hedge. The buy is the hedge and is more distant from the primary, from the money, more distant from the money at a lower delta and therefore less valuable than the primary bet, and therefore the net is a credit to your cash account. There are three sources of risk. The risk of loss, which of course you always have, which is capped by the hedge, assignment risk, which is far more serious, and tail risk, which raises the possibility of the maximum loss, and if it's not hedged, can turn your naked put into a catastrophic loss. Because of assignment and tail risk, the cash commitment required for brokerages is far in excess of the max loss. You better understand that about this. That reduces the effective return on investment, which means that although you are credited at the outset, the cash is not available to you. Well, that was long-winded, and that was quite a bit. So that at least tells you what these put credit spreads actually are. We're going to continue to gather background information and refine our models such that we can use a model to potentially identify when you would want to enter a trade in one of these. So that is at some time in the future.